Coming up in this video, I've got a couple stocks that I wanted to share with you that I'm watching now, as well as an overview of the stock market itself, which has something really interesting happening under the surface that I wanted to discuss with you all. First of all, the S&P 500 is a little bit lower here today off of a little bit of higher than expected inflation numbers. Let me show you. So what you're looking at is the producer price index, which is a wholesale inflation statistic measurement. On a year-over-year basis, it shows you inflation. So over here, the way to read this would be we had 6.2% year-over-year inflation overall. And this morning we had our latest figure. Check this out. So for the month of July, which was reported today in August, we did get some really interesting statistics. What we have here is the forecast for today's inflation read was 2.5%, but instead we got 3.3%. Sharply higher than expected. And this is causing some drops in some of the higher valued companies in the stock market. So for example, like Nvidia is dropping here about 1%. The stock market is about to open up in about 4 minutes from the time of recording this. We also have Meta down again, which it was down yesterday, but down another 0.9% here in the pre-market. And of course, Tesla continues to tumble here, down 1.4%. Here's an updated look at Fortinet, which is a stock that dropped big here recently that I own, down another 1.16%. Although yesterday it had a really nice recovery move, but you can see I'm still down quite a bit on the stock, but at one point was down over $10,000. So the stock has rebounded a little bit. And honestly, if I was interested in building a bigger position, I personally would be buying this dip. Again, not financial advice, but I do think that the stock was oversold on their earnings announcement. Their earnings were actually quite good. It's just that they produced lackluster forward expectations and the market didn't like that. So they sold the stock really hard. I mean, we're talking about a move down of 20% in a day and has rebounded since those lows. Another very popular retail stock, Coinbase, down 2.75%, which makes sense because the price of Bitcoin here down almost 4% this morning in response to this higher inflation print. And really quick from a macro perspective, what does this mean for the stock market? I refer to myself when it comes to stock picking as a top-down investor or trader. And specifically what that means is I'm looking at the macro stuff first. I look at inflation, I look at interest rates, I look at the economy, and then I work my way down to an individual company. So that process is top down. There's also bottoms up where you look at the individual company and then you kind of go the opposite direction. I prefer to go top down. And so when I'm looking at the economy, it does put me a little bit on the pump and the brakes side of things when it comes to buying stocks, because what we can see here is that inflation this week was sort of mixed. You did get a CPI print that was lower than forecasted, but at the same time, you also got a producer price index number that was significantly higher than expected. Meanwhile, we have some lackluster PMI data, which is an economic growth statistic, but GDP growth was strong. So there's sort of a mixed bag here, but the overall stock market impact here from our macro screener is just a 42% score. What that means is only 43% of our indicators here suggest bullishness for the stock market right now based on the economy, and the rest are bearish or mixed. By the way, the macro screener is available within a copy of the stock box. If you don't have the stock box, there will be a link in the description down below to where you can try our tools. If you're interested in doing top-down analysis, having the right tools to do so is really important. So check out the stock box in the description down below. The stock box is a relatively new tool that helps stock traders and investors, as well as options and ETF and futures traders, scan markets at a better, more comprehensive level. If you're looking to take your stock picking to the next level, consider checking out our tools and taking advantage of the 30-day trial that's linked in the description of this video below. Here's a look at the stock market, which just opened up. Of course, by the time you see this video, things will have changed probably in the dramatic format, whether up or down. But in my perspective, this puts me on pause to buying too many stocks at this time, because again, my economic or my macro screener that I just showed you is looking a little bit mixed and just not quite attractive enough for me to start really aggressively buying stocks with them pretty much at their all-time highs. And actually something that got hit harder than the broad market is the Russell, which is the small cap index in the US. Smaller companies got hit harder because higher inflation means interest rate cuts might not be as prominent in the coming months. Here's a look at a stock that got hit really hard, definitely a small one, is Cava. Cava dropped by 20% the other day. If you've never had Cava, the food is so delicious. It's relatively healthy. I think it is kind of like a Chipotle competitor, up and coming thing. You guys may know I have a bullish perspective on Chipotle, and so I'm also watching Cava, but it is a small company, high risk, high reward type of investment. So I'm watching it, but Cava has really dropped hard. You can see we had this massive run up in the stock, but from its highs, you can see how quickly these high flyers can also fall. It's down 60% from the highs. I may be watching this stock for a possible buy the dip opportunity from a longer term perspective. I do think that this stock has a lot of potential. I think they create a great product, but the question is the stock expensive? And the answer is yes. While I don't currently have Cava in the stock box data, I did pull up some information on the internet and found that it trades around a 71 PE. So very expensive stock. So probably one I would skip on, but if it continues to move lower and the earnings for the company grow over time, it may be one that I add to the list at some point. And although a lot of stocks have been recently actually moving lower, one stock that seems to be surprising to the upside today is Adobe, ticker symbol ADBE. Seems to be rebounding, and this does start to look a little bit attractive to me if you start to see some positive price action. Price action for this stock has been really negative, but it does look like it's trying to form a bottom. Let's see if we can get some sort of breakout. You can see this 20-period moving average has been acting as a dynamic level of resistance for the stock. I would love to see this thing take back some of this past resistance and maybe start putting in some higher lows, higher highs, especially when we take a look at the valuation for this company. I think it's really attractive. If you take a look at the trailing 12-month PE, you're talking about a 21.7 trailing 12-month PE compared to a 3-year average of like 48.5. That's a pretty cheap valuation compared to its own history. Remember that different types of stocks have different types of valuations. Tech stocks are typically more valuable or more highly priced because there's expected growth there that would outpace something like an oil and gas company, which is valued much cheaper but may not experience that level of growth. So it's all about the relative 3-year. That's what we use within the stock box to try and gauge how things are looking for a particular stock. And we've actually done some scoring work here to take a look at across a select basket of financials, like, for example, PE ratios, price to sales, debt to equity, revenue and earnings growth, return on equity, profit margin, and gross margin. We do sort of a holistic look at the financials, and then that helps us to guide whether or not the stock could be a better or worse buy. And so when I look at Adobe, the thing that's kind of holding me back is the stock price is in such a strong downtrend, but as we start to approach perhaps a breakout in the stock, it starts to get really more attractive to me. You have, again, relatively cheap valuation, and this meets the criteria of a stock that I could look for a possible bullish trade on. So for Adobe, I am looking for the possibility of a breakout trade and any sort of positive momentum. These sort of turnaround stocks are kind of right up my wheelhouse when it comes to stock trades. Another stock that looks good is actually Apple, which has been moving higher here and trades pretty much in line with its 3-year average trailing 12-month PE, but has a forward PE that looks a little bit relatively attractive. We also had a nice boost in earnings and revenue growth here recently in their latest reported quarter. And you can see the stock price seems to be moving with some nice momentum here to the upside. So if we were to get a pullback here on the stock, I am interested in possibly buying the dip on Apple. Would be looking at this one around the 215 to 200. Now, if you've watched my channel for a while, you know I've been kind of critical of Apple. It's a stock that I've loved over the longer term, but have been critical in recent months because I just think that they are lacking a little bit of the innovation that they should be doing with so much cash on hand. But they've recently talked about perhaps buying Perplexity or doing some more mergers and acquisitions. The CEO also seems to be playing it well with the White House, staying in line with the Trump administration as to not cause a stir, which I think is part of the job right now, is to sort of be a diplomat for Apple so that they don't get, the crosshair put on them. And I think there's relatively a good job being done there. So the stock has plenty of room to recover, in my opinion. The valuation is not insane on Apple, as long as we can get some of those mergers and acquisitions, and perhaps if Apple AI starts to generate something or generate some buzz. I think that the stock is relatively hated in terms of what Wall Street thinks about it. People don't love this stock. And so when I look at it, I actually see some possible value there. So Apple is one that if we do get a market pullback, and Apple will likely move with the market, I'd be interested in possibly picking it up on a discount. Here's a look at a very popular retail name and a stock that I own quite a bit of shares in. It's Robinhood Markets, HOOD here, pulled back in the last couple of days. And I actually did sell a call right towards the upper end of this. So let's take a look at how that trade's going so far. Today's video is sponsored by Moomoo. And if you haven't heard of Moomoo before, they're a one-stop global trading platform with over 26 million users across the US, Australia, Singapore, Canada, Malaysia, and Japan. And Moomoo offers 0 $0 commissions on stocks, ETFs, and options trades. They also offer free level 2 data and real-time options chain data, no extra charge. And the Moomoo platform is super advanced. They offer a really powerful options trading tool, and you can even track latest public figures holdings like Nancy Pelosi's directly within their portal. And if you want to learn something about a particular stock, just ask Moomoo's AI feature. With this tool, you can ask for trading insights on your favorite stocks. And if you want to tap into what institutions are buying and selling, check out their institutional tracker. This tool allows you to explore top institutional holdings. What sets Moomoo apart is their incredible platform for researching stocks, checking out all sorts of different analyst rating tools, and insider holdings and trades. And for a limited time, as shown on the dates on the screen right now, you can get up to $1,000 in NVIDIA shares, plus 8.1% APY for US users. As you can see on the screen, please follow the criteria here and make sure to use the link in the description to get the full context behind this offer while it is available. It is available for only a limited time. And are you already trading with another brokerage, but all these tools sound pretty cool? Well, I think so too. And they're currently offering a really cool 3% match on the first $1 up to $20,000 transferred from another brokerage. So if you're looking to take your trading tools to the next level, check out Moomoo and take advantage of some of the offers available using the link and details in the description of this video down below. Now back to the video. So here's an updated view of my Robinhood trade that I'm in. So I own a good bit of shares of this stock. I own 600 shares of Robinhood that I was able to pick up during the tariff sell-off in April, around $40 per share, which has been a remarkable buy. And I've been recently selling calls against the stock. I took a $7,700 loss here recently selling calls. So please understand this has not been easy, but we are sitting on a nice gain here on the recent calls that I sold due to the stock price coming down a little bit. So you can see that movement there. That's all it took to be up about $3,300 on the shares here. Again, call premium is just through the roof on this thing. So if you're selling calls, you can get paid quite a bit. And in my case, it's a covered call. Since I own 600 shares and sold 6 contracts, I have no theoretical upside risk. So if the stock, rips to the upside, I don't lose anything because I gain on the stock. I just lose on the calls, meaning those things get knocked out, nullified. So it's just a scratch. But I do have upside if the stock stays sideways or moves lower, where I could potentially buy back that call, which I sold, right? So I'm short 6 calls. I could buy those back for a profit of $3,300 right now. I am looking to get around 50% of max premium. That will probably be where I look to close out the profit if I can get that. Otherwise, if the stock price continues to move higher, I may have to take some losses on these calls and write fresh ones. But I do think the stock is still a little bit stretched. I think the broader market is a little bit stretched, to be completely honest, and do see this thing having some downside in coming days and weeks, which I've sold the 26th of September calls. Getting into some more positions that I have on, I also sold calls on NVIDIA, and I'm still long the stock. I have 500 shares, so another covered call position, which I think a covered call position sort of overall in the market represents my perspective on it. I think the market is still bullish, hence why I'm still long stuff, but I think that there's limited upside, which is why I'm short calls on a lot of stuff. Here's a look at Meta, which I'm sitting on, again, 60 shares. I also sold a call here. So the downside movement in the stock here recently has been welcomed because, again, I'm sitting on some gains. I actually may look to close out of these September 19th calls pretty soon, approaching that 50%, max profit. So I may look to just close that out for a couple $100. I also own shares of Google and also sold the September 19th calls in this one, although this is pretty much flat, has not moved in either direction very much. Here's a look at Delta Airlines, which this trade definitely not going the best, because you can see I do own 600 shares, so I'm sitting in some profits on this stock, but I've also sold calls for the September 5th expiration. So that's coming up here, and I'm down $2,100 on this. Probably what's going to happen is if the stock stays in the money like this at expiration, I'm not going to roll this. I'm just going to let this get called away and take profits on my position. So I will collect, or I will make, in terms of gains on the stock, almost $13,000, but I may have to give back some of those gains through the call that I sold, which is now in the money. So again, again, covered call here, example of one not working out as well. Speaking of one that's definitely not working out well, here is a loser for me. This is Lulu, L-U-L-U, which is Lululemon. And you can see in this case, I bought this stock, 100 shares at $243. We can see now we are way below that. I have since been selling calls to try and help with the losses, but again, you can kind of see what's going on here. The call premium that I'm collecting is not doing too much to really save the day on this one. And what will likely happen with this is I'll continue to hold the stock. If something really fundamentally changes for Lulu, I may need to go ahead and just take a loss on this one. However, when taking a look at the stock analyzer tool, selecting for LULU, the PE ratio on this one doesn't look so bad, but the revenue and earnings growth have really slowed. Overall, I'm feeling mixed on this stock and may choose to sell it if it doesn't start to turn around soon. Another stock I wanted to discuss was IBM, which actually was a request by one of our subscribers here on the channel. So if there's a stock you'd like me to cover in a future video, feel free to comment it down below and I'll consider adding it to the watch list. IBM has been selling off pretty hard here, and they had some earnings, and I guess people just were not very impressed with perhaps their forward-looking expectations for the stock. And pulling up some of their financials, what we can see here is that the stock still trades relatively expensively. And what I don't love about IBM is that when we take a look at the earnings per share, what we can see is just not a very steady kind of clean chart, right? So you have this back and forth earnings per share growth, whereas, when you take a look at a company that's growing very quickly, it looks very different than this. Even Apple, which has not had the most impressive earnings per share growth, still has relatively smooth overall upward trend in terms of the value per share over time relative to the earnings. Take a look at like Adobe, for example, which again is a stock that's down quite a bit and I think is oversold relative to this clean overall earnings per share growth that they're seeing. Here's Accenture, which is another stock we've talked in the channel, very clean overall growth in the earnings per share. But then you get some of the more speculative stuff where there's just not that consistency, like for example, AMD, which this stock could be in a trend up, that continues, but we've seen some variance here over time on this one as well. But I typically do like to buy stocks that have earnings per share growth that looks like American Express, where it's just clean and sort of steady eddy to the upside. Perhaps one of the easiest ones to give as an example would be Meta. Take a look at Meta's clean overall trend to the upside. Now, granted, you could say, well, maybe the time to buy it is when people are uncertain about the stock. So when we go back to an IBM, for example, and we say, how does this look? Again, this just is not quite super attractive to me. Now, perhaps you think there's going to be something that really turns around and changes the business that you like, but for me, this would probably be a pass personally. In terms of a value play, I think from a technical basis, you may still have room to come down and test areas like 215, or even from a longer term level of support, maybe that 200 stock price level. Another stock I wanted to talk about today was Netflix, which is showing some signs of rebounding. It looks like it's found a low here around that 1,150 level. By the way, this stock definitely, in my opinion, should split to a lower share price. $1,000 for a single stock share is pretty crazy, but a lot of times stocks, what they'll do is they'll do for like a 4-for-1 or something like that, where essentially the stock price gets divided by 4. So it's a little bit more accessible to people who don't have, $1,200 sitting around to buy one single stock share. But Netflix has been an absolute powerhouse. And going back to our earnings per share chart here, look at Netflix. It's an incredibly impressive chart. And this is why the stock is so popular. Go figure, investors love to buy stocks that have really strong growth in their earnings that is fairly consistent. And I'm not gonna lie, I'm one of them too. I much prefer to buy stocks that have growth in their earnings per share that looks very stable, consistent, and predictable. And so let's talk about the elephant in the room. Nick, why do you own so much Tesla then? Tesla does not have a clean earnings per share growth chart. It did for a while, but it's really stagnated and actually is declining here recently. But this is where if you believe that a company has significant potential that is not yet showing up in their earnings and revenues, you may choose to take a punt or a speculative, educated guess as to where you think a stock is going to go. And that's kind of what I'm doing with Tesla, for example, as opposed to a stock like Google or Meta or Amazon, these companies that just have solid growth that I think, they may not double and triple in the next year or something like that, but I think that they overall have plenty of potential to sit in a portfolio and continue to grow over time. Whereas Tesla, it doesn't really have the financials at this time, but robo-taxis and eventually all the robotics things that they're developing have the potential, not the certainty, but the potential to start showing up big time in the financials. And that's the different types of investors that are out there. Some people are more growth investors. They're wanting to, follow along with really strong growing companies that are growing at really rapid paces, which come high risk, high reward. Or there's people who like value companies, and there's also people who like, sort of more speculative investing for future, kind of potential, like space stocks. And like, for example, a really popular retail stock right now is Rocket Lab, ticker symbol RKLB, which again, pretty cool concept what this and competitor SpaceX are trying to do. They're trying to put, essentially internet in the skies as a more short-term way of making a lot of money. And this stock is really, really popular. Now, again, if you're investing for the future, what you have to be really careful about is in 2021, we saw investing for the future type, stuff do really, really well. A really simple ETF to look at is ARK, right? So ticker symbol ARKK. This is Cathie Wood's ETF that invests in things that, again, are not yet profitable type businesses. Some of them are profitable, but a lot of them are not yet profitable, or if they are profitable, they're valued extremely expensively relative to those existing earnings today. And the reason for that is because they're investing for tomorrow. And sometimes that can work big, other times it can get you into really bad trouble. Like for example, when we take a look at 2020, 2021, during the meme stock era, the ARK Innovation ETF, ticker symbol ARKK, run by Cathie Wood, did phenomenal as speculation went crazy. But there are also times where speculation can get you really hurt. And so we've seen for multiple years since that 2021 hype phase, we've seen the ARK Innovation, representative of many stocks of that nature, come down significantly. But in recent times, we've seen the innovation type, high speculation future stuff kind of come back into favor. So to me, it actually kind of looks like Tesla's lagging behind that and has potential to move higher. However, I own shares. I've also sold covered calls against my position because I do want to scale out of this stock if we enter into some sort of melt up mode in the stock market. Here's my position on Tesla updated. I've talked about this a lot here recently. I have two different call strike prices. I have the $400 calls, 2 contracts there, and 2 contracts at the $355 strike price. What I'm sitting here looking at is I've got 400 shares total. I'm sitting on some really nice gains as I bought the stock back in the April sell-off. But then I've also got the 19th of September calls. Both of them are slightly in the red. If, the stock has a couple days or a week or two of downside movement, I'll probably buy back these calls for a profit. And if the stock rips through these highs, then I may get a chance to actually just get called away from some of my shares and perhaps all of my shares if we see a run up to $400 plus in the stock by the expiration date of the 19th of September. If you enjoy my videos, please consider subscribing and hitting the thumbs up button. I really appreciate your support on this relatively new stock market channel. And if you'd also like to join our Discord and Telegram, both will be linked in the description down below. And remember, you can try out our software tool, the Stockbox, using the link in the description below. Thanks very much for watching. Have a great day.